My dear students, today we will discuss about one of the important topic of the lesson financial management, that is capital structure. Do you know about capital structure of an organization? Capital structure means the proportions or combinations of different sources of funds, say equity share capital, preference share capital, debentures, long-term loans, retained earnings, etc. Capital structure means the type of securities to be used and proportionate amounts that make up the capitalization of the organization. It means the proportions of debt and equity used in a business. So in simple words, we can say capital structure is the proportion of debt and equity used in a business. Clear? Now let us discuss about the factors affecting the capital structure. Capital structure is affected by various factors. The first point is cash flow position. The decision related to the capital structure depends upon the ability of business to generate enough cash flow. The company is obliged to pay fixed rate of interest to the debt, that is to the bank loan as well as to the debenture holders, etc. So before including the debt in capital structure, the company must analyze its liquidity. Okay? So a company employs more of debt securities in its capital structure if the company is sure of generating enough cash inflow. Whereas if there is shortage of cash, then it must employ more of equity in its capital structure. Now the second factor, that is interest coverage ratio. What is the meaning of interest coverage ratio? You studied in accountancy. It refers to the number of times the company's earning before interest and taxes cover the interest obligation. Once again, interest coverage ratio means the number of times company's earnings before interest and taxes cover the interest obligation. The equation of interest coverage ratio is earning before interest and tax divided by interest. Okay? High interest coverage means companies can have more of borrowed funds like debt. Okay? Whereas lower interest coverage ratio means less borrowed fund securities. Clear? Now the third factor, return on investment. Return on investment is another crucial factor which helps in deciding the capital structure. If return on investment is more than the rate of interest, then the company must prefer debt in its capital structure. Okay? So, the fourth one, cost of debt. Fourth factor affecting the capital structure is cost of debt. If the business can arrange borrowed fund at lower rate of interest, okay, then it will prefer more debt than equity. Clear? Now the fifth factor, that is tax rate. If the tax rate is high, then debt can be preferred. And if tax rate is low, then we can prefer equity or owned funds. Now the sixth factor, cost of equity. Another factor which helps in deciding capital structure is cost of equity. Owners or equity shareholders expect, okay, a return on their investment, that is earning per share. If debt is increasing, earning per share, then we can include it in the capital structure. But if earning per share is decreasing, then we must depend equity shares. Now the seventh factor is floatation cost. You know that floatation cost, you already studied about the floatation cost, right? You know that floatation cost is the cost involved in the issue of shares or debentures. This cost includes the cost of advertisement, underwriting commission, etc. Comparing with shares or debentures, the cost involved in raising capital by loans or advances will be low. Okay. Now the next point is, eighth one is risk consideration. Risk here means the financial risk. Okay. If the firm's financial risk is low, then it can depend debt. Whereas if the financial risk of the business is high, then the business has to depend equity. Ninth factor is flexibility. Excess of debt may restrict the firm's capacity to borrow further. To maintain flexibility, it must maintain some borrowing power to take care of unforeseen circumstances. Okay? Now, the next point is control. You know, equity shareholders are the real owners of a joint stock company. You know that. They have the complete control over the company. If existing shareholders want complete control, then they should prefer debt, loans, etc. If they don't mind sharing the control, then they may go for equity shares also. Now the 11th factor, that is regulatory framework. Issue of shares and debentures have to be done within the SEBI guidelines. SEBI means Securities Exchange Board of India. The guidelines provided by Securities Exchange Board of India. The companies have to borrow the monetary, that means they have to follow the monetary policy regulations of government. Now the 12th point, stock market conditions. There are two main conditions for a stock market. That is, you know that boom condition or recession or depression condition. These conditions affect the capital structure. During depression period in the market, business is slow, and what will happen, do you know, the investors also hesitate to take risk. Then borrowed fund is preferable. And in case of boom period, okay, the business can depend equity. So my dear students, today we learned about the meaning of capital structure and what are the factors affecting the capital structure of a business organization. It is very, very important topic. So study very well. Thanks to all.